Welcome to the weekly wrap up. I am very happy to report this week that interest rates are better at the end of the week than where we started at the beginning of the week. So, much anticipated jobs number today came out, and surprisingly enough, that jobs number was over 115,000 more jobs were created than we expected. And in general, that would cause our interest rates to really increase. But when you really look at that jobs number, we see that unemployment actually increased. We see that wages that employees can demand are going lower, which is big. And we also see that not all, many of those jobs that pushed us higher than what expectations said were in leisure and hospitality, which we know were really, really hit with COVID and have been underemployed since pre COVID. And actually, compared to 2019 and 2018 records, are still underemployed even prior to COVID. So, overall, this was a very good read for interest rates, and it is definitely starting to show that inflation is slowing, the economy is slowing, and the other big thing that's helping us today is there is a bank in Silicon Valley that is on the verge of failing. The Fed is watching it. There is talk of them bailing it out. I hope that doesn't happen, but that bank does have some definite ripple effects to other banks, and that too is helping keep our interest rates lower today because that shows truly that there are many cracks in this economy that just are starting to be revealed. All of those things are good for interest rates. Next week, we have the CPI number, which is the most important thing for inflation as a read. We also have a Fed meeting next week. So if the inflation number comes in lower, we should be able to see interest rates get even better. Now, keep in mind, from our February 2nd, that were some really incredible rates, we moved a full point worse. So right now, we've recovered probably a quarter to 3/8. And if those CPI numbers come in better next week, we should be able to recover maybe another quarter to 3/8 of that. But we are still a good quarter point off or so from the best rates that we saw beginning of February. But we are hopefully now turned the corner and trending in the right direction to get those interest rates back down from our February bloodbath. Also in the news, keep in mind, April 15th, conventional mortgage rates will go up for closings after April 15th. If you have no idea what I'm talking about, please call me or shoot me an email. I will send you a video or I will explain. Basically, for conventional loans for people with credit scores of 720 to 760 with 20% down to 5% down, your interest rates are going up. Counterintuitive, that's the facts. There's nothing I can say about it. Doesn't make sense to me either. But the other thing is FHA, now that they reduce their monthly mortgage insurance costs, FHA is becoming cheaper on a monthly basis for many of our clients. And so that might be something that you as agents may have to dust off a little bit of love for FHA simply because conventional is going to be more expensive. And when we're doing a side-by-side comparison, FHA is cheaper depending on the situation. So we'll talk more about that down the road. If there's any other questions that you have for me, please do not hesitate to reach out. That's what we're here for. And fingers crossed for better rates as they continue next week.